Well, data week came and went, and it was pretty interesting. We got the job openings report, the JOLTS report this week 400,000 more job openings than the previous 30-day period, but I don't buy it. We got the October jobs report this morning 261,000 jobs created. My question is, since when is that a lot? The Federal Reserve, in the face of all of this, still somehow went 75 basis points this week. To quote John Malkovich's character in the movie Rounders, bad judgment. And second pop culture reference in 10 seconds. Tony Soprano once said, remember when is the lowest form of conversation? Unfortunately, I think that's all we have with our current Federal Reserve. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills, right on Cannon. Hope you had a great week. All right, we got the job openings number, which I find to be a very interesting number every month. And somehow there's 400,000 more job openings than there were in the previous 30-day period. This literally makes absolutely no sense. This is window dressing by corporations, similar to what money managers do on the last day of the quarter. They buy stocks that were up for that quarter, so when they send their prospectuses out the next day, essentially, it looks like they have winners on their book. But what companies are doing here, oddly enough, the same companies that have hiring freezes and are laying off people are also putting up job openings on job boards, and that's where this JOLTS number comes from. So the corporations are actually window dressing the job openings to make themselves look like they're healthier and stronger than their competition. Meanwhile, I bet you if you actually applied for one of those jobs, no one would call you back, because if you read the other article they wrote, they're having a hiring freeze. So unfortunately, I used to find the JOLTS number very helpful. But if the corporations are going to try to manipulate it to make themselves seem stronger than their competition, all we can do is throw the JOLTS number out for now until some things start to normalize again. Moving on to the September jobs report that we got this morning, Friday morning, 261,000 jobs created, a little higher than the 195,000 Wall Street was looking for. But I got a question. That's not a comment. That's not a lot of jobs, 261,000. We used to need 400,000 20 years ago to be a blowout report. I don't know what this jobs report is, especially headed into the holiday season and all the seasonal hiring that goes on. We'll see what the November jobs report looks like, early December, but this 261, this isn't a lot. I don't know how it can be interpreted as a healthy number. Unemployment ticked up from 3.6 to 3.7%. I haven't been a fan of the unemployment number for a long time because one of the things is when you can't claim unemployment after X amount of weeks anymore, you don't get counted. So the unemployment number does not count people who can't file for unemployment anymore. They just fall off of all charts. So I don't really think the unemployment number is that accurate, to be honest with you. And then wage inflation, flat year over year, and up 0.1% from the previous month. Well, this is back to my whole idea of what's the difference between a job and a career. Job, again, you can be replaced. Your employer can you can replace your employer. Your employer can replace you. Careers, mutually beneficial, very hard to replace each other. In a career, you're going to find wage inflation. In a job, you're not going to find any wage inflation. These are clearly jobs, not careers. And to keep up with the price of food and gas, we need people starting careers. Moving on to the Federal Reserve themselves, 75 basis points this week. I don't know what they're doing. Not only have they caused payment inflation in our country whenever you go do anything, they've also caused payment inflation in internationally. Because as we know, everybody plays off of our dollar, which has gotten a lot stronger. So the price of goods has went up. And the dollar has gotten a lot stronger. So now people all over the globe are dealing with terrible inflation and price inflation. And a big part of this is actually caused by the Federal Reserve, who just wouldn't let things chill out and let the stimulus work its way out of the economy. So Federal Reserve, not sure again what you're doing. I'm not going to pick on you today. But good luck down this path of nothingness at this point. You can raise rates as high as you want. You're not going to bring the price of gas down. You're just going to cause the price of everything to go up and then squeeze the consumer on every possible end. What the consumer needs right now is some relief, not higher prices on everything. I don't know if they don't run errands, if they don't put gas in their car, if they don't buy their own groceries, but they've got to actually just go run errands with a normal person on a Saturday afternoon. and you'll see that costs $100 to almost fill your gas tank, costs $100 to almost get 2 bags of groceries at the grocery store. And God forbid if you go get your dry cleaning done or something, that's another $100. And guess what you've done that day? Nothing. So good luck to the Federal Reserve. If they keep us up, undoubtedly will go down as the worst Federal Reserve in the history of our country. Out of touch, and they're going to be out of time soon, like that old song, out of touch, out of time. But they got to get their story straight because they are literally going to put us into a depression, the D word. And then back to my earlier reference, remember when, as Tony Soprano once said, is the lowest form of conversation. But I think that's all we have with the Federal Reserve right now. I'm going to talk about remember when pre what we dealt with for the last 2 years, hearkening back to the late first quarter of 2020. Mortgage rates were at 4% then. Makes sense. They are off their lows and trading in a range. That's where they should be today. Price of gas was about 50% less in some places than it is now. Not California, of course, but price of gas was a lot less then, and that's actually where it should be on this whole normalization path that they're going towards. So I go back. We have a $30 trillion economy. We dumped $5 to $6 trillion into the economy. Let's just say a mortgage was at 4% on a 30-year fix back then and they wanted to fight the inflation. Fight it percentage-wise. Raise your rates so the mortgage rates would end up at 5%, not 4%, like it was to combat the perceived inflation of all the money dumping you did. For these mortgage rates to go to 7% is completely insane, and I got news for you. Not only is the consumer, who they had tabbed completely wrong, the consumer didn't leave their house for 2 years, saved a bunch of money, paid down their credit cards, and had nowhere to go spend money. Now it's the opposite. You can go look at the bank's earnings calls. Savings accounts are down, credit card debt is up, and as that credit card debt goes up to help pay for this inflation of putting gas in the car and food in the refrigerator, these banks are actually going to run a risk of default because their rates are going up with the Fed's rates, and people are buying these things on credit now, where previously they had built up their savings. So to say there's been a shift in the consumer in the last 9 months is an absolute understatement. I hope the Federal Reserve can get their story straight. They have caused the worst payment inflation in my time in the business here. And like I keep saying, they should have let the $5-6 trillion work its way through the economy. They had it right. They got scared. They knew they couldn't help gas. They knew they couldn't help food. And somehow they think raising the price of everything else is going to help bring down gas and food, which are the two things, and electricity and water and whatnot, the things people can't live without. But people can live without the luxury goods that they were just buying to buy because they had extra money during the previous 2 years. They're not buying those things anymore. So Federal Reserve, stop. That's it. Big stopping red flash sign. If you don't get it now, it might be too late and you might not be able to help the economy when you think you should. Okay, everybody, that is my show for this week. Not doom and gloom, not cheery, just kind of realistic. We're basically in an unprecedented place right now where it's up to the Federal Reserve to have a soft landing, and it looks like that's going to be harder and harder for them to negotiate. Okay, everybody, that's my show for this week again. Thanks for watching. Appreciate you. Any questions related to your mortgage or anything real estate, give me a call, send me an email, shoot me a DM, whatever it is. Please stay safe and have a great weekend. Thanks again for watching.